favorite time of the month, buddy.
That's great. This is our April OPEX conversation. I think we've been doing this for 2 years. I don't know. Every time we do this, I go, how long have we been doing this for? But thank you all for joining us today. And we want to send a special welcome to those of you coming over from Zero Hedge, our partners at Zero Hedge. Were kind enough to link up this conversation that we're going to have today. So welcome to, obviously, our SpotGamma subscribers, YouTube subscribers, and those of you coming from Zero Hedge. I am Brent of SpotGamma. This is Imran from Options Insight. And what we're going to do is talk about some of the interesting flows we're seeing into the April OPEX. There's a couple of very notable flows, I think, taking place. And then just give an idea of what we think is going to happen out of options expiration. We tend to generally sync up on our views, but we'll see if we can get into an argument here. And then after this conversation, we're going to take some questions about just general options education. We have a course called The Hedge. So if you go to academy.spotgamma.com, you'll see Imran's handsome face up there. And we have a training course that leads you everything through what is an option all the way up to volatility hedging and things like that. And so we're going to take some questions. If y'all have any kind of options theory questions, we will be doing that right around 1:45 Eastern time. So with that, Imran, that was a lot to say. Thank you for sitting through all that. You and I were talking before this. We're pinning. That's what the market's doing here, right? Not a whole lot is going on. You and I are in sync on the idea here that we have these big options positions at 4150, 4100, 4200, just kind of that sandwiched area that is holding the market in. And as a result, realized volatility is dragging down. We've done really nothing in the last 2 weeks, I think, in terms of price action. And the VIX has hit a 1-year low, which is getting you excited to buy tons of puts. True story?
Well, I definitely want to start covering shorts and getting long, but I've been doing this long enough to know that when vol looks cheap, it's usually not that cheap, right? Yeah. So low, you tend to see vol really shooting through the lows because it's not worth owning, and often it's because everyone's long it, right? So for example, the reason why I'm convinced that we probably will pin this week, and when I say pin, we're gonna just be probably somewhere between 41.25 and 4200. Okay, so give myself 1% either way in a 2% range, and that's just because implied vols got so destroyed in the front end options last week, and that was even on a day where we had like a 1.3% rally on S&P, and the fixed strike vol in April was offered. Okay, and really, you've got a 2 sigma move there based on where the implied vol was on those options, and yet they're still selling the vol. So that only really happens when everyone owns it already, right? So you're kind of getting information there that's telling you the whole street owns this stuff. It's a big open interest, but whenever there's a big open interest, you can make assumptions about whether people are long or short, but it's the price action of volatility and whether the realized is really low that really confirms to you that everyone's long. And so for me, I got that confirmation last week, which is why I then entered in a trade to try and play that pin. So I brought up my old pinning playbook, which is basically iron condors for Friday. So I've been sitting on an iron condor since Friday last week, which is doing okay, touch wood, so far.
That's funny. So I agree with you on your statements around positioning. And on the chart here, you can see the pinning taking place, obviously, here around 4150, as you mentioned. Here's the VIX on the bottom that is just slowly making its way to 16. And, so we're implying 1% moves with the VIX. But to your point earlier about positioning, when we were talking about the bank crisis in mid-March, and that was right around mid-March kind of expiration, coincidentally, if you look at expiration, I think we're right here, right? The low, basically. Nobody wanted to be short vol into that SIVB weekend, right? Sovereign bank weekend. I don't know that necessarily there was a lot of demand. We did a video on this saying that we didn't see huge demand to buy puts there. But I think everyone was a little bit nervous to sell vol, particularly in the weekend where things were really going bad, right? It wasn't clear what the government was going to do or regulators were going to do and how that crisis would resolve. And you kind of get just after March OPEX and you go, okay, nothing else is breaking. Credit Suisse was sold, whatever's happening, kind of cleared the room out. So suddenly you go, okay, this is VIX 25 or whatever, implied vol is high. maybe people are long puts, hedging the tail risk there. Everyone just started selling it, and that really just accelerated. We showed this chart of the put index earlier on Twitter, and what's so interesting about the put index is that this sells a 1 month rolling basis at the money put. This is a SIBO product, right, that they track. And this performance year to date, so January to now, is the best performance since 2017. But what I thought was more interesting than that was you could see this put selling strategy, totally reversed its gains, so to speak, into the bank crisis, and out of the bank crisis, it exploded. So you have record year-to-date move in this index, which is basically just selling an at-the-money put a month out. But that record move really happened just in the last month, right? So that just gives you another idea of how quickly volatility just got taken to the woodshed, and how quickly people jumped on the opportunity to sell volatility. And now, we're at this OPEX pin. Volatility is really at a low. And on Friday, a lot of these positions that are holding the market in around 41.50 are set to expire, as we were talking about earlier. What do you think about OPEX rolling off? We have a couple of people asking about this, but OPEX is going to happen. We know these positions around 41.50, give or take 1%, are going to go away. Do you look for volatility to expand there? Do you give you a directional bias after this? What's your thought there?
Yeah, I mean, I don't have so much of a directional bias. Seasonality has also played a factor in this vol sell-off, right? So typically, if you don't have a really good reason to buy vol tends to sell off into Easter, right? And also vol was coming from a place of being elevated because everyone was shitting themselves on the banking stuff, right? So as that boogeyman goes away and you go into a quiet period of Easter, those seasonals kick in and everyone finds themselves caught long vol because you've got some big structural call sale positions as well. Like the JP Morgan collar trade expired at the end of March. We ran into that strike. Everyone was choking on $20 billion notional of those options. And then they went and sold a chunk of June options, which supplied the street with a load of Vega. So you've got enough systematic supply coming and giving the street upside calls. And at the same time, you've got a seasonally quiet period of Easter where people don't want to choke on decay too badly. So they're all like, it's a hot potato, right? They're all passing the vol off to each other and they don't want to touch it. Now we're coming up to FOMC on the 3rd of May. In theory, that should be a little bit of a catalyst. But the problem with that is we're now pricing in about 85% probability of one more hike and we're done, basically, right? So if the market kind of gets confirmation from Powell that it's one more hike and done, the whole rates complex. I mean, you look at rates vol's been collapsing, right? So if rates vol is done for now until we see more data and we see a significant shift in rates expectations, which moves it from where it currently is, which is a lot lower than it was at the start of the year in terms of the rate path, until you get rates vol moving again, it's hard to really see what the catalyst is to really make equity do a lot, right?
Yeah, and I think personally, I think that works maybe both ways, and this will bleed into macro a little bit. But my view is that we're going to pull the pin. We're probably going to consolidate next week. Maybe we give 1% or 2% back. Volatility will come up a little bit, and then typically we're going to have some event vol for FOMC, right? Doesn't mean that VIX has to go to 30 or anything like that, but for vol to sell off into FOMC is, I think, rather unlikely at this point. So we get a little consolidation, I think, next week, and then we'll see what Powell does. I don't know if the debt ceiling is going to matter. I don't know if there is more credit risk with banks, and some people say yes, and some people say no. There's extreme bearishness, in the markets, which people are saying from a sentiment perspective. I think it's ironic because the VIX is at 2-year low. So how bearish could sentiment be?
Well, I've got a point on that. I think what people have done is because spot has been quite resilient, right? Because you had that massive tech rally, everyone rotating back into tech. The headline S&P levels are actually quite elevated relative to what we would have thought, given that we've got a banking crisis going on, right? So I think people have just used the rally in S&P to lighten up exposure, which means they don't need to buy puts. So you'd only see an expensive VIX. People needed to buy put protection against their longs. But if they're just saying, you know what, the outlook for the next 6 months looks like a nightmare, a recession's pretty much a done deal, the market's given me a gift being up here, I'm just going to get out and sell futures, then it explains why vol and put skew have been coming down, basically, because they just don't need it again, right?
You could be right there. And my counterpoint to that be if people are selling futures, it's not being reflected in the S&P price at the moment. So, you do bring a good point. Maybe you just kind of maybe just sort of unwind. And to the point of the bank crisis, I'm not going to pretend to understand the ins and outs of that. But when you look at, I have the KRE here in blue.
No doubt.
People love buying the dips, right? In everything. That is what we've been trained to do since 2020. And you cannot get a dip bought in this thing. And Apple came out, right? They offered this account. They got $60 billion apparently, pulling from Schwab and the like. Bank of America had good earnings this morning. It was up pre-market 2%. It's kind of giving some back. So this issue to me is not cleared up yet. And I think if this was rallying, you would see it cleared up. And so, yeah, the rate situation, I think people are saying, okay, we're probably nearing the high of rates, and maybe that's why the rate vol can come down. But now are we just sort of passing the baton from like, hey, we're concerned about what rates are going to do to, hey, we're concerned about recessions or other systemic issues, excuse me. It'd be kind of curious. And I don't know what to make of the debt ceiling issue. I think the earliest that could start to crop up is not really until June. So, there's a little more party on in this very short dated time frame environment that we're in, looking forward. We touched pivoting slightly. We talked very quickly about AI, and you said that you don't know what Chat GTP is. I think you're the first person I've ever met that doesn't know what it is.
I did not say that.
So a lot of people are talking about tech, right? And maybe tech and AI is the truth, or it is this sort of, it is going to offer the economic production or the future or the growth that we need to kind of like pull us out of the doldrums, right? Tech has been doing, pretty well. If we were talking about Meta a little bit, obviously Apple's not necessarily AI, but that's doing pretty well here, back near all-time highs. McDonald's is just an amazing stock, unrelated to AI. But
I was going to say, what AI have they got going on?
It's just amazing. I mean, it's just a beast. And so, back to the point of tech is that I think that you have the other issue here of a rally of, what sector you're in is going to matter, right? Owning tech versus maybe owning a value or something like that could play a lot into what does well or what doesn't do well. Obviously, with S&P, you get a kind of a blend of everything, right? But the factors here maybe matter a little bit more. Do you sort of look at that if you're going to start looking to play a rally or play a bigger move higher in the market? Even if you think the S&P may stall, are there single stocks that you like looking at here versus indices if you want to play some pair trade? Or how are you sort of structured if you want to play a rally?
Yeah, I mean, I haven't really sort of leaned that heavily into tech. I'm not 100% convinced on the whole AI is going to save the world story. I mean, long term, clearly there's a productivity boost of some kind coming, right, from AI. But it just, it's going to take a little bit of time for people to know how to use this effectively to actually boost productivity. But then also, you may well get a load of job layoffs on the back of it as well, right? And how's that going to play out in terms of unemployment? So I don't know what it's going to look like. There was a bit of an opportunity to buy some healthcare about a month ago, bought some calls on XLV because I thought people would rotate towards defensives and feel more comfortable in defensives. And that's had a good run, but that's probably a bit overdone now. But yeah, it's not clear to me that these stocks are good value, right? I mean, people are a lot smarter than me on the macro side and in terms of valuing these stocks and saying where they should really be, are saying that, okay, everyone's piled into Nvidia and Microsoft and stuff like that, but it's like they're just trading at too expensive levels, right? So whilst it's a good story and it will have an impact, massive impact on the world in the future, it's still not clear that you need to buy the stocks at these prices, right? So I don't know. I think a lot will depend on whether the Fed narrative changes, right? People are now expecting cuts by the end of the year. If they hold it higher for longer, if they pause rate hikes after the next one, but then they hold it there for the rest of the year, that might give tech a bit of a wake-up call, because I think the tech rally is somewhat relying on getting some cuts by the end of the year, right? And if those cuts don't materialize, some people are saying that pricing 2 or 3 cuts by the end of the year isn't actually the market pricing 2 or 3 cuts at the end of the year. What they're doing is they're saying the modal outcome is we stay at 5% at the end of the year, give that an 80% probability, but then there might be a 20% probability that rates are cut by 250 basis points because we go into a real shit show on the banking crisis, right? So those are really the two scenarios. The scenario of, oh yeah, they start cutting and they slowly cut 2 or 3 times by the end of the year is a fairly unlikely outcome, because for them to suddenly reverse engines from the hiking cycle they've just experienced to get inflation under control is a bit weird, right? Like you see my point?
Yeah, I totally see your point, and it's this thing about known unknowns and unknown unknowns, and I think there's a lot of kind of unknown unknowns that we all get this feeling that, you know, either you're betting on a soft landing, right, which is a pretty clear, or even a higher for longer scenario. At least you feel like you know what's going to happen, right? But there are so many variables and curveballs here that in this environment that you kind of don't know what could pop up, and to me that there's a tail risk present here that maybe feels like it wasn't present a year ago, and I think a lot of that is related to the banks and lending. And again, the debt ceiling and stuff I don't quite understand, but the valuations, to your point, I mean, you listen to some of the fundamental guys, the valuations don't really seem to be great. If earnings, we're talking about Netflix coming out tonight, if earnings are better or stronger, then maybe there's a little bit of a catalyst there. But this is a market that has really struggled with current price levels, as you can see here. Tech's had a blistering kind of outperformance so far this year, but how many times we've been at this 4,200 level over the last year and just fallen flat on our face, right? And so far, every time that implied volatility has gotten down to around this level, regardless of sort of what tenor you're looking at, maybe not so much the longer dated, but it's been a buy, right? And so, sometimes there's that axiom of, and I know these axioms get old, but buy it when you can, not when you have to. And I just feel like because realized is at a 1-year low, implies now at a 1-year low, we have these unknowns coming up. What is the catalyst to push another leg higher? I don't quite see it. And then I just circle back to this price action of, again, not just the regional banks, but you look at some of these REITs, VNO or commercial real estate, things like that. These things, these prices stink. And again, people are looking for value and all this stuff. And there just doesn't seem to be a big buyer in any of this stuff. And again, it's such a market where people buy the dip in everything. Why aren't they showing up in some of these sectors, which I think are pretty meaningful?
Yeah, I mean, I agree with you that it's hard to see what the catalyst should be for a rally, but it probably is the pain trade. Like someone made a comment that the pain trade is higher. I kind of agree the pain trade probably is higher, right? I don't think discretionary portfolio managers are long enough. I think they got spooked by the banking crisis. I think discretionary money has lightened up. I think systematic money has been buying because they're just price momentum chasers and they've had to buy, right? Passive money still coming in through 401ks and things like that, as Mike Green always points out. So until you get a big pop in unemployment and the 401k flows stop, yeah, I could see a pain trade higher. And what I want to know from you is what you think about vol. And if we were to pop through 42.50, are we going to see spot up, VIX up dynamic like we've seen, a few times?
Yeah.
What do you think?
We talked about this briefly, and I thought that was going to be a dynamic that would be stronger this year because there'd be more upside chases. And I think depending on what the Fed may say, you could see that again, depending on, what sector you're looking at. I think spot up, vol up in the Qs, for example, is much more likely than the S&P because I think the S&P is so diversified that there's parts there that will drag it down, right? Maybe energy is a drag or banks or financials or whatever. Whereas, the pure play of tech, you're more likely to get that spot up, vol up chase. And to your point, if you're lacking in allocation or not 100% sure of the rally, buying calls makes sense because you can hedge that upside exposure, your career risk, as our friend Darius likes to say. You can't afford to miss a rally, right? If you're a trader on a fund desk. And so, yeah, spot up vol makes sense. I think more so in Qs and tech than the S&P kind of writ large. But again, it's a little bit of a tricky spot. On this point of VIX, we're on spot up vol up. Couple of questions here about VIX expiration tomorrow. Brad Brantley, how you doing, Brad? He says VIX expiration tomorrow. Is that going to play into things at all? What's your opinion on that one?
Well, we've owned April puts. Like our subscribers will know, I took them off today. I as we blasted through a load of reasonable amount of open interest, the way that thing's been charming is for people to dump VIX futures into expiry. But I imagine most of that's done now, right? So I kind of didn't see the point in going into the expiry print and being exposed to that thing like going higher or whatever. So yeah. I've had some 18 strike puts on VIX expiring tomorrow. I've taken them off. I think I took them off for like 80 cents or something, right? But I think the May futures have got really pummeled as well. The whole curve's come down a lot. If you compare like the second contract, so May to the fourth contract, the steepness of that thing is like near the highs that it gets to normally. So this is a pretty extremely steep curve. So some mean reversion, like you're calling for, that the market retraces a bit and VIX mean reverts a little bit higher. I could definitely see that happening. I've been trying to think of ways to get long the VIX in May that aren't going to, kill me in terms of carry and things like that. So call spreads, broken wing call flies, things like that get you long like the 20 area and you lean against the short, the 25 area, something like that, because the skew is still quite steep in VIX. It's like 40 vol. If you look at 25 delta riskies, they're like 40 vols for the calls over, right? So it's still quite steep. So you can take advantage of the upside skew in VIX by selling that stuff against any calls that you buy and get a decent risk rewards. So those are ways I like owning May VIX right now.
Yeah, I think where we've seen the VIX expiration be more impactful is when there's a relatively higher level of volatility, and I think that just gives you more room for markets to kind of be pushed around, around the expirations. And so we've seen kind of really big rallies before VIX expirations when the VIX is relatively higher and there's a little more kind of juice in it. And I think I pretty much agree with you here. Like we're in the basement and I don't really know what the impact of that's going to be. But when you start to talk about the OPEX pinning, right? Sometimes things get a little bit looser when you have the VIX expiration a couple days before the S&P pin. And so we've been telling our subscribers is, don't get too cute with this. If you want to play like a little bit of a mean reversion, start to look at putting that trade on now. You may risk a little bit of carry, but puts are so cheap, you can size it away that, okay, I'll pay the carry. And I think the risk reward is pretty decent if we get, a little bit of a pullback next week. That the vol pop should be pretty decent there. So it seems like you and I more or less agree that VIX expiration probably not a big factor.
Yeah, I think the move is already kind of done on VIX, right? I don't think the VIX is going to go down that much more for the expiry print, and so and therefore I don't think it's going to have too much impact on the S&P. And you can see the S&P is kind of holding in at that 4150 area. It just can't seem to shake it, right? And I think that's because the outstanding gamma on the S&P itself is pretty huge, right?
Yeah, it's a very positive gamma environment. If you look at the breakdown of that here in the expiration concentration dashboard, orange is call delta, blue is put delta, and you can see that there's just way more call delta right now than put delta. If you look at this from a gamma lens, it tells you basically the same thing. There's just a lot more calls. I think there's volatility is contracting, and so all that is kind of going to crescendo, I think, into expiration, which is why I think the market's going to kind of mean revert here, give some back next week, and vol is going to increase a little bit, as we were talking about before. On this point, I wanted to show some zero DTE stuff that continues to be a hot topic. Some people think that, not every move obviously is associated with zero DTE, even though I talk about it a lot. But yesterday we saw just this incredible rally, which is right here into the close, right? From, not incredible, it was super strong from about 2 o'clock roughly into the close. We moved about 20, 25 handles, right? And if you look at the zero DTE flow, so I'll turn that on now. In white is the S&P 500, and teal is the 0 DTE options flow. So if this teal line is going up, that tells us people are buying 0 DTE calls or selling 0 DTE puts. And as you can see right around 230, the flow just launches, right? So we did a lot like this yesterday where we kind of just were very quiet and pinned. And then it's like this 0 DT sucker punch comes in. And so while today looks a little bit sleepy, I'm on watch for that, particularly if we pull away from one of these larger gamma strikes. If we drift down to like 41.25 or we drift up to 41.75, I really like the idea of 2 o'clock, 2:30, putting on some type of a butterfly or call fly or whatever it may be, call fly, put fly, that plays reversion into one of these gamma strikes. If you're kind of a higher frequency day trader, it's something that I think is pretty interesting, and the moves are so sharp. But on this point of the big reversion, right? There's this chart that I want to show, which comes from Morgan Stanley, which I think is so fascinating. I want to kind of get your opinion on this. What Morgan Stanley shows here is the 0 DT gamma of S&P 500 options. So I believe this is, as you can see here, SPX and SPY. Incidentally, our data shows SPX, SPY, and ES futures. We just added those options in. So we really encompass the entire market now. But in this case, what it shows is that dealers are short gamma, which tells us that traders are buying calls and buying puts in 0 DTE throughout most of the day. And then around 2 o'clock, 2:30, it seems to shift where all of a sudden that dealer short gamma is covered, right? So traders monetize their puts or calls depending on, whichever way it may be. And it seems like a lot of times, obviously by the close, those positions are all going to expire, whatever they are, and people try to monetize those things, right? So there's this clear or very interesting inflection point where it's long 0 DT at the start of the day on net, and then by the close it's being covered. But this 2 o'clock area seems to be 2:30 seems to be this real interesting inflection point. Obviously that played out yesterday, as you could see that inflection point changed. And then today, as we were just kind of talking about the pin, it's worth watching as we come up here in the next half an hour to see if we get that kind of big 0 DT response again. What do you think about, as a former dealer, right? What do you think about this idea of how you want to react to this much kind of gamma coming in and out by the end of the day? How do you think this is generally hedged? Or what do you think the market impacts are of this?
It's a good question, right? I mean, I suspect a lot of the action is done electronically. So I don't think it's like when I was a dealer at the banks, we'd have salespeople come in and ask us for quotes in like blocks of options and stuff like that. I think a lot of this stuff is being done electronically intraday, right? That it makes sense to do this stuff like that because, so much of it is time decay based and stuff. So I imagine, there's various algorithms out there that are, buying or selling the options and, trying to find the optimal time of the day to trade out of them and stuff. But this is something we talked about before, right? It made sense that if people are using these options to speculate, then it makes sense that that's going to create some mean reversion intraday. Because if you've bought a one-day option and it's worked for you, you're probably not going to sit on it till the close, right? You're going to monetize it, right? And by monetizing it, by definition, it's grown in delta because it's made you money. So the delta must have started relatively small. It's grown. You're getting rid of it and selling it back to the street if it's gone up, or if it's a put, you're getting rid of it and buying delta. So they are both mean reversion delta flows, whichever way it's gone, if it's made you money. And if it hasn't made you money, then obviously it's just decayed to zero, which means the gamma of it has disappeared anyway, right? So you're either getting the end user selling back the gamma because the thing's increased in value and is worth something, right? Or the gamma is just decaying throughout the day and doesn't have anything left at 2:30, basically, right?
Yeah, and I think it becomes this game of musical chairs, right? Like if I'm long an S&P put this morning and the market's moving down, the penalty for not acting on that position because the gamma of the position is so high, you don't want to be the last guy to wait to close your position, right? So once the market starts to move, particularly you get into 2, 3 o'clock in the afternoon, it's like, oh man, this put that I had that was just worth whatever, $20 is only worth 10. Like I got to get something out of this, right? I got to react so fast. And so I think that you get that kind of reflexive feedback loop very quickly that spools up or winds back on itself. So that it's really insightful. I think it's quite interesting. Tony here says that there's some massive ES prints at 41.52. So those ES futures volume, I mean, it's so large, just as a point here, that a lot of times traders are focused on the SPX and SPYs, the big 0DT flow. I'm just trying to scroll down to show the ESF. This is just the ES futures flow. And what's so interesting to me about it is, let me just bring up today, make sure I got today just loaded up here. What's so interesting to me about it is that there's this weird synergy between the ESF and the SPX. But as you can see, these positions indicate that futures calls are being kind of bought here, right? As we move higher. And then if you flip around and if you look at SPX, you'll see that oftentimes this flow really kind of will offset the ES flow. So the point here that I'm trying to get to is that there is also this weird differential between products that are all linked to the S&P 500, but I suspect that there is some sort of fairly large offsetting flows, I guess, in there, as well as just sort of some people saying, hey, instead of buying an ES future to hedge here for the day, I'm just going to buy the call or whatever it may be. And I think that could go for the dealer side as well. So maybe there are some of that long buying, right? So maybe that offsets some of the flows that are happening. Sorry, I just had another kind of interesting question here. The idea of RC here says, what if the algos hold cash settled options into the close? In theory, if you're cash settled, no big deal, right? You're great. You can just go home. Cash will go into or out of your account. You have to worry about position. In the spiders, I think it's a bigger deal to get out of the 0DT because you could be assigned. You don't want to be assigned a short, spied position if you were just sort of short a put, right? And just had a one-day view of things. So I think that you're incentivized in spiders, which is big flow, to obviously close those positions out before the end of the day in a way that maybe you're not in the SPX.
Mm-hmm. But yeah, I mean, the reality is, it's like, in my experience, when you buy a call option and it goes in the money and it's got a massive delta on it, even if that delta is expiring on the close as cash, you don't necessarily want to sit there and just be exposed to the move between now and the close. Right? Yeah. So that's your motivation to close options out early is because they've made however many X the premium, right? So generally you're going to go into trades with the target. I'm going to spend X. If it makes 3X, 5X, whatever it is, I'm going to get out of it. I'm not going to wait around to see what my destiny is to the close on what happens here. I've made enough. I can get out. I can roll it out and buy something longer dated. I can roll the strike up. I can do all sorts of stuff. But just sitting on a monster delta position for the last hour of the day or whatever probably isn't what you want to do, from a systematic perspective.
Yeah, and I see what you're saying there, and I agree. I think at the end of the day too, the gamma of these, the gamma gets pretty, the out of the money positions can get pretty cheap, and so I think there's some just interesting ways that you could also hedge to or adjust those 0DT positions. How do you think about the way that so there's been this constant idea of 0DTE suppressing, or the VIX is dead because of 0DT. And I think we did a big presentation on this. You go to our YouTube channel, you can watch our 0DT presentation, but the 0DT percentage of flow disappeared. And I have that chart when the bank crisis hit, right? So suddenly we went from very high levels of 0DT as a percentage of volume to all of a sudden it dried up, right? And Vega became this important thing. The VIX spiked to 25 or 30 or whatever, right? And you can see
that makes perfect sense, right? Because
and you can see that little dip right here, right? It's subtle, but this is 35%. Whereas on Friday we hit 51%, which I think is the second or third highest ever. We're back up in the kind of mid to high 40s of 0DT flow. So this idea of like the hedging long term is gone, so 0DT flow comes back, right? There's a coordinated trade here, it seems like.
But it's systemic risk, right? Like systemic risk doesn't get hedged with one-day options, right? So you don't know when the system's going to collapse, right? It might happen in a week, it might happen in a month, it might happen in 6 months, right? But if you really are worried about the banking system going pop, one day puts aren't going to save you, right? That's the thing. So that's why it makes sense that hedging budgets would not be using, if it was hedging budgets, right? They wouldn't be using such short dated options, right? When we're in a world where every economic data point has the potential to move the market 3%, then there's value in using zero DTEs, right? But now we've just got our break in the system that has priced the rates market to pivot. And that's what we were waiting for, like for how many months, right? Back end of last year. When's something going to break? When's something going to break? They're going to keep hiking till something breaks. Now the rates market has told you they've broke something, right? And that's why they can't hike more. Well, the rates market doesn't think they're going to hike more than one more time, right? So therefore now you're not in that same world where we are so responsive to every economic data point, right? Now we're like, oh shit, the recession's coming. It's inevitable. And so it's more systemic now, the issues. So if we want to hedge that recession scenario because we think it's not good for equities, and that's debatable whether recession is good or bad for equities, right? Because in the world we live in now, tech stocks go to the moon when rates are low and we're in a recession. The stock market does not equal the economy, right? We learned that in COVID in 2020, right? But anyway, the point being that if you wanted to hedge the market, you wanted to hedge your exposure for an oncoming recession that is being priced by the rates market to some extent, you got to own longer dated protection now, right? So that's what.
Yeah, I totally agree with you. And a couple of interesting points on that. One, the event risk tied to these data prints has really subsided quite a bit. It's really fascinating to watch. I mean, you get just massive implied moves into the CPI, the jobs number, this or that, and that has really faded rather sharply. But to your point earlier, there's a lot of evidence that suggests that, look, if I'm long a put, let's say I'm long a December put, and the market drops 2%, I go and I buy a zero DT call as a way to hedge that out, right, for the day. If I think there's going to be a bounce, I think there's a lot of flow that plays this zero DT flow that plays this mean reversion and is kind of contingent on getting big market moves. I guess sorry, go ahead.
No, so I mean, in terms of using zero DTEs for hedging, whether that's done or not regularly, I don't know. But, the fact that those zero DTEs on big macro data print days used to be pricing in quite expensive, right? Suggests that there was a lot of demand for that optionality. Now, I happen to know, funds that run billions of AUM that used weekly options to hedge on a regular basis. Whether they use zero DTEs or not, God knows. They certainly used 1 week type stuff to hedge their exposures because they were trying to hedge a specific macro catalyst, right? So I think the market's evolved, right? And clearly the volumes have exploded in this stuff. So some people are utilizing them for that reason, right? Who knows how many?
Yeah, and the other thing that's interesting, and we'll probably leave the zero DT conversation here. I think there's a lot of reasons you want to use it for hedging, but the flow has really just topped out. Excuse me. Sorry, I'm looking for the chart here on that volume. I think I cut it off the presentation, making y'all sick scrolling through. So thought I had it on here. The volume overall, if you look at it, has really it's subsided, right? So we had, overall options volumes expired. Percent of zero DT has been stable at 45-ish%. And so, whatever the strategy was or strategies that were unlocked with the daily expirations, right? When Tuesday, Thursday options were added kind of in the end of September, there was this explosion in zero DT volume, but then immediately after that exploded, it's just stayed stable, right? So it's almost like if new strategies were being unlocked or there was a lot of, VRP or whatever it may be in these options, you would think more flow would kind of come into it. But the amount of flow that's being traded there has really stabilized, which I think is also kind of a very interesting point. Because you also see the put call ratio on the zero DTs is generally 1-to-1. So puts and calls trade on average a 1-to-1 put call ratio, whereas longer date options trade, 1.5 puts to every call, right? So there's clearly a different use case, but whatever that use case is, it's kind of in a way maybe maxed out, right? And so whoever's using it isn't finding an expanded need for it.
Yeah, I mean, it's interesting. Like Mike Green was talking about this phenomenon, right? And he obviously talks to a lot of clients in the option space, and he was of the opinion the majority of institutional use of this stuff is to sell options, right? So there's rather than selling the 1 month stuff, they now just sell smaller notionals on the 1 day stuff, and it's just a better way of doing it. But if that's the case, then Morgan Stanley's research is a load of nonsense, because that's saying that they're net buyers of it, right?
Yeah, I think that Mike Green is wrong on that one. If you look at so JP Morgan, Bank of America, what's on the screen here, Morgan Stanley, our internal research, it all suggests that in the morning it's buyers. So I think if you actually look at the flow, you go, okay, people are buying kind of the more at the money. Maybe they're selling the wings a little bit. But I just, you see buying in the morning and selling into the close is sort of what what it really looks like. And that's 3 investment banks agreeing with our, research there. And I think that there's a whole lot of strategies, right? I don't know that there's enough reward in it for a meaningful, how much alpha is there, right? For a 0 DT selling, if you have, a couple $100 million under management, I just don't know that the risk reward is that great, but there's a lot of smart people out there, so maybe they've figured that out. A couple questions here from Chase. Chase is a big fan of your buddy Jam Croissant, and he says,
I've never spoken to him.
Oh, I thought you guys had spoken before. My bad.
No.
He says that he's identified a May window of weakness, and also identified a February window of weakness. Is there a way that you think you could look forward now and say, okay, there's cyclical flows or whatever it may be that's going to make May have a higher probability or February have a higher probability of weakness? You're talking about seasonality before versus, some weakness here after the April options expiration.
Well, I mean, obviously everyone knows the sell in May and go away phenomenon, right? But the problem is you can sell in May, but it might take you 2 months before the market really materially sells off, right? It's just saying that if you seasonally get a rally into April, May time, it's a good time to take your chips off the table and wait to see what happens, right? And if we're heading into a potential recessionary summer, which a lot of people think we might be, it's probably even more the case where people will be incentivized to sell in May and go away, right? So, yeah, whether the window of weakness, as he likes to call it, kicks off post May OPEX or not remains to be seen, right? Yeah, like I say, I think it could take a while for the data to roll over, right? Julian Brigden, who I'm a big fan of, thinks July payrolls are going to print negative, right? So is that a catalyst, right? Is the banking stuff going to kick off again? Are we going to see some bad things around the commercial real estate at some point later in the summer? Who knows, right? We don't know when it's going to happen, right? But the point being is with the market at 4,200, a lot more the smart macro guys are all thinking there's limited upside in the market, which does make it likely we get a pain trade squeeze, but it also probably means that that's short-lived and we roll over again. So the scenario I think personally is the most likely is that we're still a bit bearish in terms of sentiment. We're pinned for expiry. We get rid of the pin. We're freer to move. Yep. Whether we dip and then rip or we just rip directly, I think we get a test above 42.50, try and squeeze some more shorts. Vol catches a bid on that rally because it's already too cheap on the upside. And then the market rolls over at some point on a more meaningful catalyst, basically. So that's kind of, for me, that's the rough sketch of how I see things playing out over the coming sort of weeks and months.
Yeah, and I more or less agree with you here. We got to kind of wrap it up and start the hedge conversation here. One of the questions about 4,200 in our daily notes, we've been saying 4,200 is our peak into Friday expiration. We don't think that's our call wall. We don't think we're going to breach that. I'm looking for a pullback next week and then some path dependency. When you look at May, if we are ripping into May, I think there's a better opportunity for the market to sell off after OPEX, right? This idea of mean reversion. But if we're crashing into May and a bunch of puts expire, then I would look for a bounce. And I think the reason that you could say, hey, the window, we could have seasonally weak moves into March or June expiration is because there's always big puts at those quarterly expirations, right? And if you start to get some weakness in those quarterly expirations, there's some reflexivity there as those puts gain in value. It helps to draw the market down. If we didn't have if we didn't get the bank crisis in mid-March, we had some February weakness. We had a little pullback, right? But if we didn't get the sovereign bank issue, we may have just popped right back up to 4150, and who's to say what would have happened in March expiration? So there's a lot of path dependency to trying to predict that far into the future, and who knows what Powell's going to say, right? If he says the right thing, market goes up a whole bunch. Wrong thing, maybe he can make the market get very weak into May expiration, at which point then we could see again that bounce after. But at least in the shorter term, we're looking at now, I think 4,200 is our high, certainly into Friday. But I am looking for a pullback there. We need to transition now. We got about 15 minutes left. We need to transition to talk about the hedge. So we have an academy. Let me leave this page. It is called The Hedge, as I've mentioned several times. My pretty face is at the top, but it is Imran who walks you through all these courses. So one of the things that Imran did is he designed a course which is given to institutional banks over there in London where he sits. And so we thought, hey, you've written this course that's good enough for some of the largest banks in the world. I think everybody else would like to get access to that. And so, we teamed up to offer this course. It's a really comprehensive course. There's a bunch of different levels to it. You can take the whole bundle if you want, or take individual specific courses if you think you're a little bit more advanced. I encourage you to actually just do the whole thing because it helps to reinforce a lot of that knowledge. But one of the things we want to do here is we want to take some questions about just general options theory. If some people have some questions about specific things to trade or different thoughts on the market that they'd like us to explain, please put those in the chat, and we are happy to answer those. Imran, is there anything you want to say specifically about the course, what you think people get from it, or anything you really want to draw people's attention to?
Yeah, I just think it's a really good foundational course for you to get to grips with options, the intuition behind how to trade them, why the vol surface matters, what information it tells you. But when I teach, I try and make things as practical and understandable as possible, right? So we're not deriving black scholes. We're not trying to keep it super theoretical. It's all about trying to keep it practical, which is why within the course we also do try to reference SpotGamma's tools, SpotGamma's levels, and how you can maybe lean on those levels to structure certain trades that make sense. So there are examples of flies, condors, calendars, things like that I might do to lean on the fact that you've got a call wall here, on a certain expiry or whatever. And so the market might be sticky going into that expiry and struggle to break the resistance. And then afterwards it will move. So then you do a calendar trade to leverage that view and things like that. So again, we teach you the theory. We teach you what all the different strategies mean, what all the terms mean, just basic option pricing theory, what the parameters are that go into pricing options. And then we try and apply those so you can actually start to learn how the thought process of actually constructing trades and trying to make money works as well, because that's a whole new ball game as well. Right?
Yeah, that's immensely helpful. It was interesting. I was listening to a video yesterday. This is only sort of related, and it was a tasty trade video on rising stars. And there's a gentleman who had a very large portfolio return selling 0 DTE options, and he was a full-time software engineer in for some defense company, and he has top secret security clearance. He's like running out to his car midday to trade options. And I was like, so this is kind of like crazy story. But he was talking about rolling positions out, right? And some of the common spreads and trades that we talk about, right? And and basically he was able to find sort of success in managing, the positions with trading iron condors around, 0 DTE. And sometimes trying to hedge those out. And so a lot of people get confused about how you maybe want to manage some delta risk and things like that, which is another great reason for the course. We have one quick question here from Luna, who asked if we personally have any videos about Charm. Charm is something that you cover in the hedge, right? So why don't we spend a couple of minutes talking about Charm, and then we can wrap that up. So I'll pass the floor over to you to discuss how Charm may be a impactful flow to watch.
So charm is the way the delta of an option moves through time, right? So delta of an option is not constant through time, right? So let's say right now the S&P is at 41.55. If you were to trade a Friday expiry 4,200 call right now, it would have a certain delta on it, right? Off the top of my head, maybe it's got 20 delta on it, right? Something like that. Okay. But that's today's Tuesday, right? On Thursday, it's not going to have a 20 delta on it with the market still here. So from a dealer's perspective, if I'm a dealer and I'm long that option because a client has sold me that option, right? Then I'm going to be selling 20% of the notional as futures to be delta hedged, right? On Thursday, it might be a 5 delta call, right? So I would have had to cover 15% of the delta 15% out of the 20% that I'd sold. So 3/4 of the delta that I had sold, I'm going to need to cover by Thursday if the market is still here. So the charm is me through the passage of time and the decay of that option. The charm is me having to cover my delta because the delta of the option is changing. Yeah. So the change in the delta is called the charm, and dealers have to rebalance their hedges because of charm. Right. So when you know there's a big position that's expiring in a few days and you know which way around the street is, and you know that the charm effect is going to make dealers buyers or sellers of futures, then you know that that flow of those futures buying is going to be supportive to the market. If it's futures selling, it's going to be obviously depressing the market, right? Which is why I mentioned on the VIX, I believe that the charm on the VIX was such that VIX dealers were charming longer VIX and they were going to need to sell VIX futures. And that's why we've seen so much pressure on VIX futures into expiry tomorrow. And similarly, what we often see in S&P, because dealers tend to be long the upside and short the downside, is that charm effect through time as we head into an expiry makes dealers buyers of futures. And that actually means the market is better supported into expiry because of that charm flow. And then once all those options clean out and go away, then maybe the market weakness can kind of kick in, which is why Sem, for example, always talks about a window of weakness post-expiry, because he's of the belief that the charm flow is the thing that's supporting the market. And once the charm's gone, then the market can sell off. Yeah.
That's right. And if you think about gamma is highest for at the money options and increases as we get closer to expiration, right? So another way to think of this is that every day we march forward, like the gamma at 41.50 is going to increase relative because of the decay of those out of the money positions, sort of like how time decay also picks up as we get closer to expiration. So are there, in general, I think about charm being a factor, the kind of like week of OPEX, right? Or if you're trading a single stock that has a lot of expiration on a Friday, maybe it's a factor. But, is that when you're really sort of thinking about this concept of charm as opposed to like next week, as you mentioned before, we're likely to unpin. There's not a lot of data decay relative to the monthly options, right?
Yeah. I think it's all about the last week, really. Yeah. The last week and a half is when the charm's really going to matter to you. So you want to get a sense for whether there's a big kind of skew position in the market where the street is long calls and short puts or whatever, because that's where you're going to get the most charm, right? If the street didn't have a skew position, if the street was just long both wings or short both wings, there'd be no charm because they'd offset each other, right? So if the street owned a load of upside calls at 42 and a load of downside puts at 41 and they were expiring this week, well, the charm completely offsets each other. Both those options are decaying down, and the delta hedge on each of them is decaying down. So there's nothing to do, right? But it's when the street is long one side and short the other side, then the charm impact is the same way on both options in terms of what the delta the dealer has to do. And that's when it becomes amplified, right?
Now, in a similar vein, let's touch on this one maybe before we end. The other big one that we always hear about is Vanna, which is obviously the change of delta due to shifts in implied volatility. I think Vanna is obviously a bigger flow when implied volatility is higher and really shifting around, like the vol is higher, right? In this case, the VIX keeps kind of drifting lower. We're kind of just grinding lower, which I think is a tailwind for markets in this scenario. It just kind of gives us a little bit of supportive flow. But when are the times where you look for Vanna to be maybe more impactful? Or sort of pay more attention to what those flows may be?
Yeah, so certainly when you got like an FOMC meeting where the market's got like a 5 vol point premium to what you think it's going to have after the FOMC meeting, so there's a vol reset coming because that Vanna, like you say, is the change in delta with respect to a change in implied vol, right? But we don't know what the change in implied vol is going to be most of the time, right?
Mm-hmm.
That it's a stochastic thing. We don't know, but what we do know is going into a known event, they pump the vol up. And there's a gravity to that. And after the event, the vol gets crushed. So because you've got, with pretty high certainty that the vol's going down post-event, then it's worth knowing what the Vanna effect would be, because that is then going to be supportive or not to the market, right? Depending on which way around the street is.
Right. And I think in this kind of instance, we're at how much, volatility premium is there right now, right? In the S&P, it's hard to argue that there really is any, right? You basically have to bet on,
It's done.
Right. And so charm is the dominant flow here as we're a couple of days before expiration. And if markets come down next week, vol pops a little bit with the Fed, then Vanna becomes a little bit more of a metric, to watch, so to speak. If you're interested in this kind of thing, we have some charts here that look at Vanna on our indexing pages.
I like your new dashboard, man. It looks good.
Yeah, we're going for that modern. Modern. We call it modern. So
dark mode. You're going for dark mode.
Yeah, dark mode. But this is our Vanna model here, where we have a volatility spot vol model. We adjust vol a little bit to try to show you how it impacts versus just kind of like strict delta. And so that implied volatility adjustment can have a big impact on delta. There's a couple of videos on our YouTube channel about that, but more importantly, go to our hedge course to really dig into all of that. So Imran, we're now approaching the top of the hour. I'm trying to be timely. I appreciate your time as always. We're doing a Macro Avengers podcast next week, right? So you have the podcast.
No, not next week. On Thursday this week.
Sorry, Thursday, 2 days from now. Sorry,
Yeah.
I will be there. It's in my calendar. Besides the wonderful podcast, which people should check out, well, tell them how to get the podcast, how to reach you, maybe on Twitter. What you got?
So got various channels. Options_insight is my Twitter handle. We put loads of content on Twitter, so check that out. We've also got a YouTube channel where you get an insight into what our subscribers get. So you get some snippets out of our daily videos that we produce. We put our podcast on there. I did a great interview with Brent recently called The Art of Trading. I mean, this guy is just got so much wisdom when it comes to trading. He's been trading for like over 30 years. He's seen it all. It was a really good conversation to have with him. And then we're gonna do our round table that we try and do every quarter. We get a few friends together in the chat room, and we have a good chat. So Darius Dale's coming, Macro Alf's coming, obviously Brent's coming, and I'm sure I'm missing someone. Who am I missing? Oh, how could I forget? TG Macro, Tony Greer's coming as well. So we should have a nice, well-rounded conversation to cover all the bases in terms of macro, vol, everything like that. And then finally check out our website, options-insight.com. Find out what our products are. We are actually running a bootcamp, Options Insight Bootcamp, at the end of April. So if you're interested in that, all the info will be on our website.
Sweet. Thanks very much for that. SpotGamma, try us out. 7-day free trial, spotgamma.com. And I will talk to you Thursday, but then also next month for May OPEX.
Look forward to it, mate. See ya.
Thanks, buddy. See ya.